Now, the third very common type of derivative is options. And these come in two primary flavors. A call option is the right to buy a certain asset by a certain date for a certain price, which we call the strike price. But you can see the important difference from futures and forwards here in this word option. Remember, futures and forwards obligate you to buy, if you're long a future or a forward, you're obligated to buy the underlying asset at a certain price at a certain time. A call option gives you the right, but not the obligation to do so. And analogously, a short position in a future or forward gives you the obligation to sell the underlying asset at a certain price at a certain time, whereas a put option gives you the option to do so. You have the right, but not the obligation to sell a certain asset by a certain date. And the reason we say buy is because options also have some differences from futures and forwards, not just in your responsibility to transact or freedom to transact, but also in the timing of the transaction. So the other important dichotomy in options is that an American option can be exercised at any time up to maturity. So you have the right, but not the obligation, to buy or sell, depending on whether it's a call or a put, at any time while the option is still good, before it expires. Whereas a European option is sort of more like a future or a forward, in that while you still, different from a future or a forward, have the right but not the obligation to make the transaction, you can only make the transaction at that specific point at which the option expires, that pinned down point in time. So let's look at how option prices are quoted. So again, let's look at date back in 2015. We can see, first of all, what the underlying asset is trading at. The bid on Google back then was 532.2. The ask or offer was 532.34. And of course, again, that would mean that if you wanted to buy a share of Google, you would buy it at this higher price. And if you wanted to sell a share of Google, you would sell it at this lower price. And this bid-ask spread reflects how liquid this particular market is, how worried any market maker is about the potential for informed trading, and just how much it sort of costs to run this market in terms of charging a bid-ask spread as a source of revenue for actually making a market in this case, Google. So now let's look at some options on Google. So these are all call options, and we can see that we have the right, but not the obligation, to buy Google. We can pick whatever price we would like to. We can even give ourselves, or buy for ourselves, the right to buy Google at a substantial discount. Price of $475 relative to its spot price of about $532. But, of course, we see that this right would then come with a substantial premium. And this is the other big difference between options and futures and forwards that sort of comes with the territory of options giving you rights but not obligations, whereas futures and forwards give obligations to both sides of the transaction, since as the party buying the option, you actually aren't obligated to transact, and since we know that rights can't really be bad for you, they must have a positive value, well, that means that the price you should be willing to pay for this right to buy Google, but choose not to buy it if it's not to your advantage, must actually be a positive amount. In other words, in exchange for buying the right to buy a share of Google at a certain price sometime from now, let's say 1 month from now, or 3 months from now, or 6 months from now, as in the June, September, and December maturities. Since you are buying something that can't possibly be bad for you, you must of course be willing to pay a positive amount for it, and so we see that to buy the right to buy Google, we would pay 61.8 per share to do so by June, 68.9 to do so by September, and 76.5 to do so by December. It should not surprise us that the cost of this right goes up the more time we have in which to do it. So a longer maturity option is actually worth more than a shorter maturity option. And of course, for all of these, the bid price is still going to be lower than the ask price, so we can sell somebody else the same right as we could buy for ourselves. But if we sell it, we'll sell it for a little bit less than we could actually buy it for. And then the other thing that you see is that as the strike price goes up, in other words, as it costs you more to buy each share of Google, you can see that the right of doing so becomes less valuable. Because, of course, by the time you, let's say, are bidding for the right to buy one share of Google at $5.75 a month from now, you can see that right now Google trading at $5.30 means that there's a relatively high chance that it won't even reach $5.75. Of course, if you are in the perspective of May 13, 2015. But the farther out you go in terms of the maturity of the option, the more chance there is for the price of Google to reach even that higher threshold. So you are still going to be willing to pay more for that right. So these are the options to buy a share of Google at a pre-specified price. These are the call options. Let's look at put options, the right to sell one share. Here we can see sort of the opposite pattern, which also makes sense. Remember, a put option gives you the right to sell at a pre-specified price, so to be able to sell a share of Google at a relatively low price of $4.75, where it is currently trading at $5.32, is not worth very much to you, because you'd rather sell it in the spot market for $5.32.20 than buy the right to sell it for $4.75. But the reason that this right still has some positive value is, remember, you don't have to actually take advantage of it if it's not to your advantage. If the price of Google remains high, you won't. But what this does is it gives you a measure of insurance, in the sense that if there's a market crash or something peculiar to Google happens that drives its price below $4.75, let's say by September, then the reason that you're willing to actually pay $9.20 for the right to be able to sell it for $4.75 is essentially like an insurance premium that guards you against this exact possibility. And then again, you can see that the longer time you have to actually exercise this option, to sell Google, even if it's at a really low price, the more valuable that right becomes, simply because there's more chance of something seriously wrong happening to Google that would cause its price to fall to this level or below, where it would make sense for you to exercise this option. And you can see that the higher the strike price rises, for example, the right to sell a share of Google for more than it is currently worth is actually worth a substantial amount of money right now, and that's the 1 month horizon, and the more time passes, the more valuable that right becomes, as you have sort of a longer time window over which you can choose to sell it for that much if you want to, because of course over a longer window of time there's again more chance for the price of this underlying asset, Google, to fall even lower than where it is right now at $5.32. So let's say what we do is we're optimistic on the prospects of Google, and what we want to do is we want to buy 100 call options for December. Now, if each of these options costs us $29, in general, an options contract will give you the right to buy or sell 100 shares of Google. So we would buy one contract that would give us the right to, if we're buying a call, buy 100 shares of Google with a strike price. Let's note the strike price is X of $5.50. Per share, that rate would be $29. What would our profit actually be on this position? Remember, we're doing this for 100 shares, because that's sort of the default size of each option contract. So what happens if we have the right to buy Google for $5.50, but its price is actually below $5.50? Well, that would be this region over here. So pretty much along all this continuum before we hit $5.50, our right to buy Google is not worth very much. In fact, we would just choose not to exercise this option. And of course, what that means is that we would essentially have just lost this $29 premium per share for 100 shares. In other words, our loss would be $2,900. Now, if the price of Google rises above $5.50, we'd still want to exercise our right to actually buy those shares, because at least we could recoup some of our premium. And indeed, sort of the key point would be where the payoff intersects the horizontal axis, the price at which we actually at least recoup our premium that we paid per share. Remember, we paid $29 per share for this right. So if Google is trading at $5.79, that would be a price at which we would break even on this purchase of the long call option, because then we would make $29 in exercising this option, because we would buy Google that is worth $5.79. So we'd receive a share that is worth $5.79, but we'd only pay for it that strike price of $5.50. So we'd make $29 on the exercise of the option, but of course our net profit would still be zero because we paid $29 for that option per share. But then if the price were to rise even above that, then we would actually start making positive profits. Let's say Google were worth $5.80 per share. Then we would exercise our option. We'd buy it for $5.50. We'd make a $30 gross profit. And after subtracting out the cost per share of that option, we would make $1 net profit. So every dollar after that break-even point becomes $1 of net profit for us. And the maximum loss from this trade would be the $2,900 in lost option premium that we would essentially give up if we don't exercise the option, if it is not optimal for us to do so. What about put options? Well, let's say that we instead want to, instead of being long a call option, let's say we want to be short a put option. Now, of course, we'll talk a lot more about options in the future. We can sort of see a similarity here. Both of these are essentially positions that have an optimistic view on Google. It's just that now, instead of buying a call option and hoping to buy it when it appreciates for a fixed price set right now what we're saying is, if the price of Google falls, we're willing to take it off your hands for a predefined price, but we're just betting that it won't. So what is the payoff diagram in this case? Well, let's say what we do is we sell a September option. Remember, each option is going to be, again, for 100 shares. And the strike on this option is $5.25. So we have given somebody else the right to sell us 100 shares of Google for $5.25 per share. And while Google stays above $5.25, that is all well and good, because remember, when we look at the bid quotes for these options, we'd actually see how much we would gain by selling somebody this right. And if the price of this option was, in other words, the premium that somebody would pay us in exchange for us giving them this right, that would be $22.40. Since each option specifies a contract size of 100 shares, we'd effectively have made $2,240 minus transaction costs in the selling of this option. And that is what is essentially captured by this net profit while Google stays above the strike. If the price of Google doesn't fall, then whoever we sold this right to won't exercise it. We just get to keep that $22.40 premium per share for 100 shares. That is a maximum gain we could make on this trade of $2,240. But, of course, the reason that somebody is willing to make this deal with us and somebody would want the right to sell Google to us for $5.25, even if it's currently trading at, let's say, $5.32, is because they're worried about its price falling. So what would happen if the price of Google fell below this critical point of $5.25? Well, then we would start actually making less than we would hope, because now we'd be receiving a less valuable share of Google, and it would become more and more less and less valuable to us as that price falls. So we can again think about where the break-even point would be, where this payoff would intersect the horizontal axis, and that would of course be where we have lost as much on having to buy Google at $5.25 as we have gained in the premium for selling that right to do so, which would be the difference. That would be the $5.25 minus 22.4, or 502.6. So at that point, if Google were worth only 502.6 at maturity of this option, or when it was exercised against us, since we were the ones that sold it, we would effectively make a loss of $22.4 per share, because now we'd be receiving a share of Google worth 502.6. We'd be paying $5.25 for it, but our net profit would still be zero, because that's exactly how much selling this right has earned us, again, net of transaction costs. But then if the price of Google falls anywhere below that, then we start actually making losses. And you can see that selling put options has actually a fairly unattractive looking net profit diagram, simply because you have potential for large losses. Let's say Google falls to 400. Then for each share, you've effectively lost $125, because you've bought something that is only worth 400 for 125. Yes, you received a 22.4 premium for that, but that hardly offsets the total size of the loss to you. But of course, the hope is that this simply doesn't happen, or perhaps one actually has an informed view on Google and thinks that any sort of price decrease is temporary, so they don't mind taking this temporary loss and then potentially selling this share that they bought for $5.25 when it actually rises above that threshold again. So these are the payoffs to sort of the two types of option positions: long a call, short a put. But of course, you can then flip these, because remember, with all derivatives, the gain to one side is the loss to another. So you can then pretty easily infer what would be the payoff to the side that is short the call or the side that is long the put from these two diagrams. And just as there are very many exchanges trading futures, there are also many trading options. Again, they're at the end of the book. Options, futures, and other derivatives on page 843. So to sort of contrast these, remember, a future or a forward contract gives the holder the obligation to buy or sell at a certain price, whereas an option gives the holder, the person who is long the option, the right, but not the obligation, to buy or sell at a certain price. So the option has that extra dimension of who holds the right, and then it specifies where it's the right to buy for a call or sell for a put. The future or forward obligates both parties. So if you are long a call, you're obligated to buy. Or sorry, if you're long a forward, you're obligated to buy. If you are short a forward, you're obligated to sell.